The fixed income market. Fixed income securities such as treasury bonds are a type of debt instrument that provides returns in the form of regular, or fixed, payments and repayments of the principal when maturity is reached. These instruments are issued by governments, corporations and other entities to finance their operations. They differ from equity, as they do not entail ownership in a company, but bonds usually have seniority of claim in cases of bankruptcy or default. Fixed income securities are generally considered a safer investment than equities or other market investments, but do not usually offer investment returns as high as those that can be obtained through other investments. The term fixed income refers to interest payments that an investor receives, which are based on the creditworthiness of the borrower and current market rates. Generally speaking, fixed income securities such as bonds pay a higher rate of interest, known as the coupon, the longer their maturities are. At the end of the term or maturity, the borrower returns the borrowed money, known as the principal, or par value, amount. The primary risks associated with fixed income securities concern the borrower's vulnerability to defaulting on its debt. In turn, this risk is incorporated in the interest or coupon that the security pays the investor. Additional risks involving the exchange rate for international bonds can be of concern, as well as the risk that changes in interest rates may increase or decrease the market value of a bond currently held. This is known as interest rate risk. Credit default risk arises if the issuer of a security is unable to pay interest and/or principal in a timely fashion. The probability of credit default risk occurring depends on the issuer's ability to meet their financial obligations and on their credit worthiness. There is a negative correlation between credit rating and yield. The lower a bond issuer's credit rating, the higher the yield that will be offered to compensate for higher risk. A change in the issuer's credit rating affects the value of their outstanding fixed income securities. There is a purchasing power risk associated with fixed income securities because the real rate of return on fixed income investments equals the rate of return minus the rate of inflation. During periods of high inflation, the real rate of return on fixed income investments may become negative. Bond pricing. The price of a bond depends on several characteristics that apply to every bond issued. These characteristics are as follows: coupon, or lack thereof. A bond may or may not come with attached coupons. A coupon is stated as a nominal percentage on the par value of the bond. Each coupon is redeemable per period for that percentage. A bond may also come with no coupon. In this case, the bond is known as a zero coupon bond. Zero coupon bonds are typically priced lower than bonds with coupons. Principal, par value. Every bond comes with a par value, the principal amount that is repaid at maturity. Without the principal value, a bond would have no use. The principal value is to be repaid to the lender, the bond purchaser, by the borrower, the bond issuer. A zero coupon bond pays no coupons but guarantees the principal amount at maturity. The interest paid on a zero coupon bond is delivered in the form of the bond price being less than the principal amount that will be paid at maturity. For example, a zero coupon bond with a par value of $1,000 might be available for purchase for $900. When the purchaser of the bond receives the $1,000 par value on the bond's maturity date, they have, in effect, received approximately 10% interest on the bond. Yield to maturity. Bonds are priced to yield a certain return to investors. A bond that sells at a premium, where price is above par value, will have a yield to maturity that is lower than the coupon rate. Alternatively, the causality of the relationship between yield to maturity and price may be reversed. A bond could be sold at a higher price if the intended yield, market interest rate, is lower than the coupon rate. This is because the bondholder will receive coupon payments that are higher than the market interest rate, and will therefore pay a premium for the difference. Coupon periods to maturity. Bonds vary in the number of coupon payments that occur until the bond matures. More frequent coupon, interest payments are considered more desirable and typically increase the price of a bond. All else being equal, the following statements about bond pricing are true. A bond with a higher coupon rate will be priced higher. A bond with a higher par value will be priced higher. A bond with a higher number of periods to maturity will be priced higher. A bond with a higher yield to maturity or market rates will be priced lower. An easier way to remember this is that bonds are priced higher for all characteristics except for yield to maturity. A higher yield to maturity results in lower bond pricing. The money market. The money market is an organized exchange market where participants can lend and borrow short-term, high-quality debt securities for 1 year or less. The market allows governments, companies, or banks and other financial institutions to obtain short-term securities to fund their short-term cash flow needs. It also allows individual investors to invest small amounts of money in a low-risk market. Some of the instruments traded in this market include treasury bills, certificates of deposit, commercial paper, bills of exchange, and short-term mortgage-backed or asset-backed securities. Large corporations with short-term cash flow needs can borrow from the money market directly through a dealer, while small companies with excess cash can lend money through money market mutual funds. Individual traders who want to profit from the money market can invest through a money market bank account or money market mutual fund. A money market mutual fund is a professionally managed fund that buys money market securities on behalf of individual investors. Functions of the money market. The money market contributes to a smooth-running economy of a country by providing short-term liquidity to governments, banks, and other large organizations. Investors with excess money that they do not immediately need can invest it in the money market and earn interest. Here are the main functions of the money market. Number 1. Financing trade. The money market provides financing to local and international traders who are in an urgent need of short-term funds. It provides a facility to discount bills of exchange, and this provides buyers of goods with immediate financing to pay for such goods. The money market also makes funds available for other units of the economy, such as agriculture and small-scale industries. Number 2. Central bank policies. The central bank is responsible for guiding the monetary policy of a country and taking measures to ensure a healthy financial system. Through the money market, the central bank can perform part of its policy-making function efficiently. For example, the short-term interest rates in the money market represent the prevailing conditions in the banking industry and can guide the central bank in developing an appropriate future interest rate policy. Also, by adjusting the interest rates at which government-issued debt, such as treasury bills and bonds, are offered, the central bank can influence interest rates for all types of fixed-income financial instruments. Number 3. Growth of industries. The money market provides an easy avenue for companies to obtain short-term loans to finance their working capital or other cash flow needs. Due to the large volumes of transactions, companies may experience cash shortages in regard to buying raw materials, paying employees, or meeting other short-term expenses. Through commercial paper or similar financing, they can borrow and obtain funds almost immediately for a relatively short loan duration. Although the money market does not provide long-term loans, it influences the overall capital market and can help companies obtain long-term financing. The capital market benchmarks its interest rates based on the prevailing interest rate in the money market. Number 4. Commercial banks. Self-sufficiency. The money market provides commercial banks with a ready market where they can invest their excess reserves and earn interest while maintaining liquidity. The short-term investments such as bills of exchange can easily be converted to cash to support customer withdrawals. Also, when faced with liquidity problems, they can borrow from the money market on a short-term basis as an alternative to borrowing from the central bank. Instruments traded in the money market. Several financial instruments are created for short-term lending and borrowing in the money market, such as the following. Number 1. Treasury bills. Treasury bills are considered the safest money market instruments because they are issued with a full guarantee by the United States government. They are regularly issued by the U.S. Treasury to refinance Treasury bills reaching maturity and to finance government deficits. T-bills have a maturity of 1, 3, 6, or 12 months. They are sold at a discount to their face value, and the difference between the discounted purchases price and face value represents the interest rate paid to investors. They are commonly purchased by banks, broker-dealers, individual investors, pension funds, insurance companies, and other large institutions. Number 2. Certificates of deposit. A certificate of deposit, CD, is issued directly by a commercial bank, but it can also be purchased through brokerage firms. It has a maturity date ranging from 3 months to 5 years and can be issued in any denomination. Most CDs have a fixed maturity date and interest rate, and they extract a penalty for cashing in the CD prior to the time of maturity. Any time after the expiry of the CD's maturity date, the principal amount and interest earned is available for withdrawal. CDs are insured by the Federal Deposit Insurance Corporation, FDIC. Number 3. Commercial paper. Commercial paper is an unsecured loan issued by large institutional buyers to finance short-term financial needs such as inventory and accounts receivables. It is issued at a discount, with the difference between the price and face value of the commercial paper being the profit and interest paid to the investor. Typically, only large institutions with a high credit rating can issue commercial paper, and it is, therefore, considered a very safe investment. Commercial paper is issued in denominations of $100,000 and above. Individual investors can invest in commercial paper indirectly through money market funds. Commercial paper usually has a maturity date of less than 1 year from the date of issue. Number 4. Bankers' acceptance notes. A banker's acceptance note is a short-term debt instrument issued by a non-financial institution but guaranteed by a commercial bank. It is created by a drawer, providing the bearer the right to the monetary amount indicated on its face at a specified date. It is often used in international trade because of the benefits to both the drawer, issuer, and bearer, holder. The holder of the acceptance note may decide to sell it on a secondary market. The date of maturity for bankers' acceptance notes usually ranges between 1 month and 6 months from the date of issue. Number 5. Repurchase agreements. A repurchase agreement, commonly known as a repo, is a short-term form of borrowing that involves selling a security with an agreement to repurchase it at a higher price at a later date. It is commonly used by dealers in government securities who sell treasury bills to a lender and agree to repurchase them at an agreed-upon price at a later date. The Federal Reserve buys repurchase agreements as a way of regulating the money supply and bank reserves. Repo dates of maturity range from overnight to 30 days or more. Conclusion: the money market exists to facilitate short-term cash flow needs. Because of the fact that most money market instruments are issued by either government entities or large financial institutions, and also because most money market instruments mature within a short period of time, money market instruments are considered among the safest of fixed income investments. However, short-term maturities and low risk translate to lower profit potential for investors. For example, while a 10-year bond issued by a private corporation might offer investors a 5% interest rate, a 3-month treasury bill might only offer an interest rate return of just 1%.